Awesome. All right, everybody. Well, welcome to our capital raising webinar entitled Capital Raising 101 Legal Essentials for Startups. Before we get into the content today, for those that don't know who we are, we're Sprintlaw. We're an online law firm really made for startups and small businesses. The way we work is a little different to traditional law firms. Instead of charging by the hour, we do everything fixed fee. We provide services in all the different areas of law that a business might need help with, setting up companies, data and privacy, employment law, IP protection, and obviously relevantly to today's topic, assistance with capital raising and all the legals that come with it. We have an optional membership, but about 90% of our customers sign up to it. It's a great way to kind of have your lawyers for your business. It's pretty cost effective. You get unlimited quick consultations with our team, a bunch of software tools and discounts on our services. We are also kind of excited to announce that we are about to launch a massive upgrade to our membership. For those who are currently members, this is probably the first you're hearing about it. We're going to be sending out an email next week. But there's a ton of new features coming in terms of being able to monitor your business's legal health, watch recordings of events like these if you miss them, and access a ton of offers, as well as a bunch of AI features and other sorts of things as well. So if you haven't joined already as a member, now is a really good time, particularly with all the new features that are about to go live. For anyone who, after this session, is gripped by the inexplicable urge to get some legal advice, we're offering free consults. So we'll drop a link, I think, in the chat, and you can also scan this QR code, or I'll show it again at the end of the presentation. And for anyone that needs help with any capital raising services, we can certainly assist. And if you're a member, give you a bit of a discount on those services. A little more about us. We have been around since 2017, won tons of industry awards, been listed as the fastest growing legal business in Asia Pacific for the last few years. A bit over 7,000 clients, a team of a bit over 50. We're from Australia, but also have expanded to the UK and New Zealand. So we are our own kind of on our own startup journey. And as I'll talk a little bit about today, have gone through several rounds of capital raising and all the ups and downs that are associated with it. And I guess really understand what that journey's like as a startup. So for today's presentation, we're going to be covering a bunch of different things. We'll be first talking about getting ready for investment from a legal perspective. What are the steps that you need to take in advance of a capital raise? We'll then go through the different types of capital raises, equity, debt, and everything in between. We'll spend a lot of the presentation thereafter talking mainly about kind of equity capital raises. That's, I think, the type that a lot of startup companies and smaller businesses are often interested in. We will, though, touch on at the end some of the documents that you may need for other funding types, like loans and things like that. As I'm going through, please feel free to drop questions in the chat or using the Q&A feature. Q&A feature is probably the easiest. I will try and answer as I go. I like to do that because we're talking about the topic and I can add a little bit of color to it. So do feel free. We may have a little time at the end as well for some additional questions, but yeah, definitely feel free to drop them as I'm going through. And I've seen we've already got one question in there about safe notes, which I will probably save to slide 4 before I answer that one, but it's a good question. So let's start at the beginning. Your business is thinking of raising investment, and you just want to make sure that you've got the right infrastructure in place in terms of the way your organization is set up to raise investment. The first, I guess, fairly obvious comment to make is if you want to raise investment for your business, you pretty much have to be set up as a company structure. There are other structures like sole traders, partnerships, and so on. It is possible to get loans and things under those structures. But if you want to raise investment kind of properly, it's pretty essential to be set up as a company structure. A company structure allows you to split the ownership of your business into shares and then divide it up between yourself and potential investors. And even if you're doing a debt type arrangement where you're not actually selling a percentage of your company, a company also is going to provide important liability protections for you to make sure that you're business liability is separated from your personal risks, at least to the extent that the bank or the lender will allow that when you raise your investment. So company structures are important, but of course, there are very different kinds of company structures that you can use to structure the way your company's organized. So on the left, we have the single company structure. This is how a lot of businesses get set up by default. We have a company which kind of operates the business. It owns the business's assets. It has its own bank accounts. It employs the staff, and it is into contracts with clients and other people. And this kind of fictional legal entity, is owned and controlled by the founders of the organization. And if investors were to come in, would also be controlled by the investors. So it's a fairly straightforward structure. You've got a company in Australia, be a PTY Ltd company, and the ownership is then split between the founders and investors. There are, though, some downsides with keeping it simple with this single company model. And to explain them, we can look at the middle model, the dual company structure. So as you start to get more cash into your business, the risk in your company to have all of your eggs in one basket, if you will, goes up because there's more at stake. So it can be a really effective strategy to split your company into two parts: a holding company, as the name suggests, that holds your important assets, such as cash or intellectual property. If you've created valuable IP in your software, or there's something patentable in what you've done, or there's some other secret source to your business, you can put that in your holding company, almost like a safety deposit box. And then your holding company would then own another company called your operating company. That's the company that goes out and does day-to-day business. It hires staff. It enters into contracts with clients. It potentially makes mistakes, which can happen when you're a startup company. If something goes wrong in your operating company, it gets sued. It needs to be shut down. It makes a big critical mistake. You are able to potentially shut down that operating company and set up another one without affecting your key assets that live in your holding company. So it's quite a useful way to separate that liability and to make sure that you're not putting everything at risk. You can see in the left model, if your IP and your cash is all tied up with your employee contracts and your client contracts, one mistake with the client and they make a claim against your company, potentially all of those assets are at risk. So that's one of the really important reasons why we recommend, before you start getting significant cash in your business and start scaling up, you think about splitting the structure. Another advantage of the split structure is if your business is going to open new business lines, expand to new countries, those sorts of things, having two levels gives you a lot of flexibility to do that. So to give you the example of Sprintlaw, we founded the company with one entity, but after a few months, we decided we're going to raise some investment, and we wanted to take things a bit more seriously and start scaling up. So we split into these two entities. We had Sprintlaw Group Pty Ltd, our holding company, and then Sprintlaw Pty Ltd, which is our operating company. The operating company goes out, it does business. The holding company holds our core assets. After a while, we decided to launch in the UK. So we created a UK entity, Sprintlaw UK Limited. It was also an operating company, and it's owned by the holding company as well. And then we're launching in New Zealand. We have a third entity. Later on, we introduced a software-specific entity. So you end up with multiple entities as you grow. You don't need them all from day one necessarily, but having the two-level structure gives you that flexibility to easily expand and keep siloing your risk into different buckets, if that makes sense. So really, we generally recommend, if you can afford it, it's nice to set up the two company structure from day one. Restructuring can be expensive. There can be tax complications if you wait too long to go from single to dual. But once you have the dual, you have that flexibility to add entity by entity later on, but you've created the infrastructure at least to do it. Noticed a couple of questions. A couple of questions about special purpose vehicles, and operating companies the same as special vehicle companies. Not quite. That collection of words, SPV, is a term you sometimes hear accountants or lawyers throw around. That's just a term for an entity that's set up for a specific purpose to do something. It could be for a joint venture, or it could be just because you want to try a new business line, and you want to separate it from the rest of your business. So it's a similar concept, but again, to draw an example of what a special purpose vehicle might look like for Sprintlaw, let's say we wanted to try going into accounting. We might set up a partnership with an accounting firm called, Sprint Accounting, and we might set up an entity just to do that, which is separated from this holding company and all of our other operating companies. And you might call that a special purpose vehicle because it's been set up for a special purpose. So it is the concept of setting up a siloed company for a special purpose, but that term's not usually used in the context of describing, just your own business and your various operating companies and so on. Emma's asked to transfer IP from the operating company to the holding company. Do you need an IP assignment deed between the two companies? Great question. I think I have a note on that on one of the following slides, but yes, the answer is you do. As I've got on screen here, you can see we've got the IP and cash sitting in the holding company and the employees and contracts sitting in the operating company. The question becomes, how do I actually make that happen? The short answer is, get legal and accounting advice, and we can help take care of it for you. But the longer answer is you would typically have what's called an intercompany agreement, where the operating company kind of agrees on paper that any IP it owns at any time from employees or otherwise will automatically, upon creation, be moved up to the holding company, which then will license it back to the operating company. And that agreement just sits in the background and makes sure that day to day all your IP is flowing up here and all the rights are flowing back. So yes, there's an IP agreement that kind of manages that. Simon's asked, how does this apply to NFP companies? I probably don't have time to cover NFPs in detail, but NFPs are a different kind of structure, and the way that you raise investment for them is quite different. You don't typically sell shares in an NFP, so it's a little bit of a different kettle of fish. And oftentimes, people who want to do traditional investment will transition from an NFP to a social enterprise, which is like a for-profit company with a social purpose, and use that to raise investment. If you are thinking of raising investment for an NFP, you probably just want to chat to a lawyer specifically about that, or for the remainder of the presentation, I'll be talking mostly about for-profit companies, but you could be thinking of it in terms of whether you might convert to a social enterprise, which, as I said, is quite common for NFPs that want to raise investment. Lots of questions coming through, so I might answer a few of them, but obviously in the interest of time, try and move on. Amar's asked about share classes. We might cover that in a little bit. Bill's asked, if you go from single to holding and trading entities, I assume that you enjoy the CGT concessions on the transfer of assets. Yeah, that's a tax question that is an important consideration, and this restructure process can be complicated if you leave it too long. It depends how you restructure. There can be CGT implications if you wait too long or if you do it incorrectly, but there can be CGT concessions if you do it the right way. And it somewhat depends on whether you keep the original company as a holding company or move it to the operating company. But it depends on what stage your business is at and so on. I would advise anyone who's thinking of restructuring from 1 to 2 to just get some accounting advice on it. And it is possible to do it in a tax effective way, but it can have some CGT implications if you wait too long. So yeah, that's the answer to this one. Mel's asked the question about impacts on R&D funding and incentives when splitting companies. I actually don't know the answer to that question. That's one for an R&D consultant. But yeah, it's an important consideration. So something to look into. Conda's asked, with the holding company model, do we raise funds at the holding or can we raise at the operating company alone? That's another good question. I mean, as my model suggests, the idea is that the investors are owning the holding company. So it is very, very typical to be raising capital at the holding company level and then distributing it to the operating companies. Sometimes you see people raise an operating company level because only one of their subsidiaries is the thing that needs capital. So for example, I mentioned before, Sprintlaw has our group company. We've got an Australian entity and a UK entity. Okay, what if we just wanted to raise capital for our UK business? Well, it's possible we would raise investment at the operating company level. If I was an investor, I would be thinking, well, I would rather go in at the holding company level because that's where all the value is. I'm not really going to have any IP rights if I just invest at the operating company level. So there's downsides to it, but you do see it done for certain businesses. So yeah, typically a holding company, except if there's some special reason to not do that. And yes, Mel, CGT means capital gains tax. That's what that acronym means. I might keep pushing through just in the interest of time. We've talked a bunch about the dual company structure and some great questions around the implications of that structure. But yeah, as you can see, it's highly recommended for various purposes when you're doing this kind of capital raise setup. Now we've got on the right a trust structure. This is at the bottom half a dual company structure in nature, but at the top half you can see it's slightly different in terms of the share ownership or the ownership in the business. So it's really a dual company structure with trust on top. Now, the way that individual founders own their stake in a company does vary widely depending on the individual founder's circumstances. So what I have on here is a common way that founders will own their shares in a trust-based structure. But I've seen tons of different ways that people do it. They have special family trust set up, or maybe one of them's overseas, so that the structure is a little different. At this part of the kind of structure, which is kind of above the company level, it does become a kind of personal advice situation for founders and potentially investors. But just to explain how this works, so in this middle model, we've kind of suggested you've got your holding company, you've got your operating company, your founders kind of personally own their stake in the holding company. So does your investors, and they're just people that may own your stake in the company. Now, in practice, rather than you as a founder just directly owning your stake in the holding company, and the same goes for investors and so on, it can be, for various reasons, beneficial to actually not directly hold your stake in the company, but rather hold it through a trust-based structure. There's a couple of benefits to the trust-based structure. From a legal perspective, we talked a little before about how a company is great because you have this limited liability, which helps separate individuals from being liable for issues that occur in the business. Employees and so on can sue the company, but typically they can't sue the people behind it. So that's why running a company is great in business. But as money starts to flow in at the top in terms of the ownership around the company, you can sometimes get disputes at this level between investors and founders. Those disputes can be more and more valuable as the company goes up. So founders often set up trust to provide another layer of protection. Not only are they protected from, issues with employees and partners and suppliers all the way down here, they're also protected from issues between founders and investors because they don't actually own the stake in the company. It's held through a trustee company. So you get another kind of shield from liability protection by holding your shares that way. And there's also tax benefits. And again, the tax benefits will depend on your situation, depend on how your company's sold. In fact, if you personally hold shares on the when dividends are issued, or when the company is eventually sold, that's coming in at potentially personal tax rates. And if the company has significant value, those rates can be pretty high. If you have a company sitting in the middle, you may be able to repurpose the funds or do various sorts of things, distribute them in a way where there's some tax benefits. And again, more of a personal tax accounting question, but this structure, I would say, is the most common structure we see people prepare for a capital raise. And again, to use the example of Sprintlaw, this is the structure that we've used. We've done, I think, 5 rounds of capital, and this has served us well. Holding company, operating company, founder trusts. Investors come in. Some of them have trusts, some of them have super funds, some of them just invest individually. But this is often what your kind of structure looks like. Couple of questions have come through on the trust. Can a trust be added later to a dual company? Yes, it can, but similar to the question I answered earlier, there can be significant tax consequences if you wait. And I will say on the trust conversion, some of our clients who have been on the whole journey of tiny little startup, raising equity capital all the way through to exit. More than 5 or 6 of them I know have seriously regretted not doing the trust restructure early on. They thought they would wait till they were a little bigger. And then they got the tax bill for restructuring from an individual holding to a trust, and it was too big, and they eventually had to go all the way to exit without the restructure. And in part, and again, I'm not a tax expert, but in part, I believe it's because, you know, you're selling the shares from you, the individual, to a company, and if the company has value at that time, then, you know, you could have a capital gains tax event. So, long story short, if you do have grand ambitions for your company to scale in the future, I would do the trust restructure as early as you can afford it, because it can get very expensive to wait. And again, just as the example of Sprintlaw, we started here. We switched to this structure at, you know, the 6 to 12 month mark just before our first capital raising round. So that's a common time to switch to the structure. Yeah, if you could afford it from day one, you might do it then, because then you don't even have to do the restructure. But if you don't have the funds to, you know, because it's 1, 2, 3, 4 entities to register and then do tax returns for and stuff, it's not super expensive, but it's not super cheap either. Then you should at least do it before or around the time of raising capital. Yeah, Bill's asked, can a holding company guarantee the debt of an operating company? So that's more of a question for a loan context when we're talking about lending investments. Yes, that's called a parent company guarantee, and it's something that lenders will typically ask for. So if someone's loaning money down here to this company that has no assets, if they're a smart lender, they're going to ask you for a guarantee from the holding company, and potentially a guarantee from even the individual founders as well. So, you know, this structure may not totally protect these other assets if you're going to get a loan at an operating company level, but for day-to-day work, you know, when you sign contracts with clients, people aren't asking for holding company guarantees and so on. So you do really benefit from this protection a lot of the time without having to worry about that. And I'll just do one more question before moving on. Raj asked, I have a holding company with 2 operating companies. If investments are needed only for one of the operating company, then investors have control over the other operating companies under the same holding company too. I kind of answered that one earlier. So if they are just investing at an operating company level, by definition, no, they aren't going to have any control over the other entities unless you put something in the contract with them that says otherwise. So they won't. But then again, oftentimes investors wouldn't want to invest in the operating company for that very reason. So yes, I think that kind of answers that question. Okay, so we've talked a little bit about structuring, and again, as many of you can tell, this can be a complex topic. Hopefully, you understand the big picture of the kind of single company, dual company, and trusts. But it is an area to get some advice on if you're gearing up for investment and kind of trying to work out what structure to go with. Beyond the actual structuring, investment is a good time to just clean up your legal house. Many people in the early days have either avoided thinking about getting proper legal documents, downloaded templates from various places, and not really put in place proper protections for, you know, employment contracts, IP registrations, IP protections. Maybe they've got key supplier arrangements that aren't properly locked down, but they're important to the business model. Maybe there's privacy concerns. Before you raise investment, you really want to make sure that you've tightened down all of your legal risks. If you have savvy investors coming in, they're going to ask you questions about this. It presents a lot better if you can say, my trademarks are registered, I own my IP, I've got contracts with all my developers, all my employment contracts are up to date, I'm sure I'm not underpaying anyone. And hey, you know, I haven't told you I've got this really great partnership, a really great supply arrangement. Well, not only do I have it, it's locked down in a proper contract. So if you can't say sentences like that, it's probably a good time to start cleaning all this stuff up. Sometimes it's the chicken and the egg. You're relying on the investment funds to clean it all up. And so you may have to say, look, we've gotten quotes for it. We're ready to go once the funds come in. But certainly things like IP protection, if it's core to your business, you want to make sure you've got that stuff locked in as early as possible. Again, we've seen what some might call horror stories of companies who've raised investment, but then didn't actually own their brand name. They didn't register a trademark, or maybe they did in Australia, but their whole strategy was about expanding to the US or another country, only to find out that their brand was taken and then they had to spend all their investor funds rebranding, and sometimes that collapses the business because investors don't want to invest it anymore in such disorganized founders that couldn't even get their brand locked down. Or you see investments fall down because in due diligence, when the investors are checking out the company, they find that these people have created all these different legal risks. So I won't go through everything you need in detail, but again, just this slide has a bit of a flavor of the different things you might think about. Is my legal house tidy when I'm prepping for investment? So now let's get into the actual different types of ways to raise investment. So for those of you thinking of bringing in investors to have a potential ownership stake in your business, which is one of the very common ways to raise investment, there are 3 or really 2.5 very common ways that people will raise investment. The first is what many people would intuitively think you do when you raise investment. You sell off a piece of the company. So under a typical what we call equity investment, a company may begin with, owned by 1 founder, 2 founders. They're going to bring in an investor who is going to be owner number 3, or investors, owners number 3, 4, and 5, and they're going to give a percentage of the company away to them. So maybe the founder started off 50-50. After the money comes in, it'll be more like 40-40 and 20 with the investors. And so in exchange for that 20, the investors put in X dollars for some amount of money. And the founders then have the funds. They go out and they'll spend them on whatever they need to spend them on to grow the pie and hopefully generate returns for the investors. So that's the equity investment raise. And again, very, very common way to raise capital. Below we have convertible notes and safe notes, which are kind of similar concepts, albeit slightly different. This is an alternative way to raise investment. You might think of these as sort of pre-sale tickets to the equity show. What you're doing with the convertible note or the safe note is, instead of giving the investor a percentage of the company right away, you're saying, invest some money now, and I'm going to properly work out the details later when I bring in a bit more money. Rather than telling you what you're going to get, I'm going to give you a discount on the price paid by future investors to get into the company. So rather than you investing now and getting 5% of the company, you might get a little more, or you might get a better deal if you just wait it out, and so it's kind of like a discount, if that makes sense. The difference between a convertible note and a safe note, and I'll go into these in a bit more detail later, is simply that convertible notes also have an interest rate. They're basically like a loan. People give you money as a loan until such time as you're ready to do the proper equity round, at which point the loan becomes an ownership stake. Safe notes are just a simplified version of the convertible note where the loan part is gone. So it's just an invest now and I get a discount. There's a bit more complexity to them, but high level, we've got the straight equity, give away a percentage of the company now. And then we have the convertible and safe notes, take the money now and tell them they're going to get a discount later on. Importantly, as you can tell from the way I'm talking about it, pretty much always the idea with a convertible note or a safe note is that at some point the straight equity round is coming, and that these investments will have the opportunity to crystallize into what the investors actually want, which is a percentage of the company. They're sometimes called bridging instruments, or used in bridging rounds to bridge a company over until when they're going to do their kind of equity raise. Hopefully that makes a little bit of sense. Now, there are other funding types. You don't have to raise money by selling a piece of the pie or doing these discounts. Obviously, there's government grants people are aware of, R&D grants, other sorts of grants offered for startup companies and small businesses. There's debt. You can take a loan, and that can either be from a private investor or a venture debt firm that specializes in providing loans, or the bank. So that's another way to get funds in, and people would be familiar with the concept of a debt. Someone lends you money at an interest rate that you then repay. We've got crowdfunding. People again would be aware of this. A lot of startups begin with a crowdfunding campaign where they'll pitch their product and have a bunch of enthusiastic members of the public put money in for some reward. Maybe they get the first dibs on the product or something special. And in the last few years, we have a new form of crowdfunding called equity crowdfunding that's emerged in Australia, where it's kind of like crowdfunding, but instead of giving people prizes or rewards for investing, you actually give them a percentage of your company. So it's very similar to a straight equity round, but it's done online. And in a traditional straight equity round, you'll have a handful of investors, venture capital firms or angel investors putting funds in the business. In crowdfunding, you'll go through a platform. In Australia, we have like Virtual and On Market are the probably two most prominent equity crowdfunding platforms, where you can list your company and members of the public can invest a little bit. And you may end up with tons of investors that have put a little stake in the business. So these are other ways that we see startups raise funds. Often it's a mix. You'll do some with investors. Maybe you get a little bit of debt and you have grants. That's kind of the landscape of funding for smaller businesses. Just quickly skimming for an additional question. So Bassam has asked, what about a dollar percentage of revenue for a certain amount of time? I presume you're talking about someone investing and receiving like a revenue share as their return for their investment. That, I guess, is a kind of unique deal. It will depend on the terms of the investment. It's probably closest to a debt. Someone's lending you money and expecting to make a return through repayments. They're not typically in a revenue share loan, as you described it, really owning a percentage of the company typically. So I'd call it a debt, just instead of repaying the debt in the more traditional sense, you're actually repaying it based on a percentage of revenue. And there are these things called revenue loan agreements, which are structured that way. Someone's asked, crowdfunding, do you need to make your company public, i.e. cannot keep it a private company? So for traditional crowdfunding, there's almost no regulation around that because you're not actually selling a piece of the company, so you can set it up however you like. For equity crowdfunding, you don't need to make it public. There was a version of the law in 2018 that required you to make your company what's called an unlisted public company. And no one really liked that because startups didn't want to be public. So they introduced in 2019, I think it was, an update to the regulations that allow you to raise equity crowdfunding while staying private. The one catch is you need to put out a couple of statements about risks in your company to members of the public, and the way that you structure your documentation is a little different. So there are some kind of conditions to you staying private, but they've purposely tried to make it not super complicated because, again, this is intended, the equity crowdfunding, for to help startups get funding easily. So it's not as hard as it might seem, and certainly we work a lot with Virtual. They've made the process really, really straightforward for compliance. Someone's also asked, Heidi's asked, you mentioned 3 types of debts. I got banks and private investment, but missed what you said about the third, something like investment debt. Yeah, so there are these funds that are fairly new in Australia, but have been around in international markets for many years, called venture debt firms. These are almost like venture capital firms, people that specialize in investments, but they specialize in loans. We work a lot with Tractor Ventures is one of them. There's also Cashcade is another one, and Fundable. And there's a ton of others out there. And these specialize in providing smaller businesses with loans. It's difficult to get bank loans when you're a small business. Often you're required to make personal guarantees and those sorts of things. So a lot of these institutions are set up to provide debt to smaller companies that can't access it. It is often expensive. The interest rates can be very high. And sometimes they want a little bit of equity as well. So they're not super straightforward, and it can be risky to take on debt if you can't repay it. So it's something to consider. But yes, there's a kind of a new set of firms emerging in Australia doing this kind of debt funding. So for those interested in getting some loans who are struggling from the banks, you might want to consider the venture debt route. And sorry, Benjamin's asked, are there restrictions down the road regarding crowdfunding? Again, I don't have time to go in detail in terms of how equity crowdfunding works, but there are regulations around, running a company with members of the public's equity crowd funds. As I mentioned, the regulations have been set up really to facilitate easy raising of investment for smaller businesses. So it's not that there's zero strings attached, but the strings attached, in my view, aren't too bad. The documentation, I think, is a little different, and it is new. There hasn't been that many companies that have, raised investment and gone through the whole process from equity crowdfunding to exit, where we can say, hey, here's a success story. It works really well. But it has been around now for 5 years or so. And we haven't seen any major catastrophes with our clients in terms of using equity crowdfunding. And if you speak to a lot of companies that have done it, I don't think that many regret it as their funding source. So, I mean, we haven't done it at Sprintlaw. We preferred the traditional route for simplicity. But for particularly consumer brands where, you could raise from a ton of investors who then become your first customers and promote your product, you could see the appeal of doing something like equity crowdfunding. So, yeah. So let's push on a little bit and talk now about equity raises. So I touched on earlier on this slide the three types of common equity-related raises: the straight equity and then the pre-sale discounts, as I described them. So let's talk about the straight equity. If you are raising investment for your business, you decide you want to get X dollars in and give 1% to your investors. The question then becomes, how does that work? What do I need to do? What are all the documents I need to make that happen? So we have on this slide the typical pack of documents that get put together when you're doing an equity raise. Now, you often start with this document called the term sheet. It's the first document on the list. The term sheet is not actually usually a legally binding document. It's like a 2-pager, 2 to 3-pager that sets out the high-level terms of investment. So, for example, a company might go, okay, I need to raise, I've done my forecasting and my budgeting. I need $200,000 for my business. What you would then do is you would put together this document called a term sheet, which says, okay, I want to raise $200,000. I'm willing to give up X% of my company, let's say 10% of my company for $200,000, which would imply, as an aside, that the value of your company in total is about $2 million. Because, if you're giving 10% for 200K times it by 10, 2 million. So you're saying, I think my company's worth 2 million. I'm going to give 10% away for 200,000. You'll then say, okay, what are my investors going to get? So you'll summarize their rights, and we'll come to some of the common rights, but you might say, you will get 10% of the company. You'll also get the right to receive quarterly updates, the right to be involved in certain critical decisions, et cetera, et cetera. Sometimes you have special rights you might offer them. And we had a question earlier about what share classes you suggest for investors. So sometimes you'll say, not only do you get 10%, I know this is a risky investment for you. I not only will give you 10%, I'll guarantee that if the company makes a loss, or I'm saying we're worth 2 million, but we're only sold for 1 million in the future, you'll get your 200K back rather than 10%. So you can give them special rights. You can say for as long as you hold a certain amount of shares, you can, sit on the board, etc. So when you give the special rights in these kinds of term sheets, they can often be called sort of share class rights, and you're basically saying not only do you own this percentage, but you actually have some additional rights on top of your ownership. So that's what a share class is. But yes, this term sheet is often going to set out what are the special rights the investor's going to get, and what percentage of equity might they get. So it's a summary document, and it's often prepared at the beginning. And oftentimes founders will just prepare that and go out and start having meetings with their pitch deck with various potential investors. So, you'll take your term sheet, you'll take your deck, you'll start emailing investors or getting introductions and saying, hey, I'm raising 200,000. Here's my pitch deck. If you're interested, I'll share a copy of the term sheet with you and maybe some more information about the business. And if you want to put down that you're interested in investing, you can sign the term sheet and we'll proceed from there. So it's kind of like the sign-up form. It's not binding because still we need these other more sophisticated legal documents to make it happen, but it's often used in that what you might call raising stage, where you're going out and trying to raise funds from a group of people. So that's what a term sheet is. Now, I should mention, if you are raising from angel investors or individuals, you may run it that way, where you prepare the term sheet. If you go to the more sophisticated venture capital funds, typically they will give you the term sheet. You could give them a term sheet if you want and say, this is what we're doing, and they'll read it and review it. But oftentimes they will have their own terms that they want to sort of invest in. And you can negotiate them, of course, but often the way the venture capital process works is you'll pitch to a fund with your pitch deck, and afterwards they'll say, okay, we'll give you a term sheet of what we think you're worth and how much we're willing to put in. And so the term sheet can kind of flow that way. But yeah, typically it is something you prepare. But as I said, with the more sophisticated funds, they will often want to present one to you. So once the term sheet's signed, there's a suite of other documents that need to be completed to make the investment a reality. Someone says, okay, I'm putting in 100K. Another person says, I'll put 50. Another puts in 50. So you've got three investors who together are going to give you your 200K. They've all signed term sheets. That's the point where you come to the lawyers, us. We will have a look at and I should say we can help you with the term sheet as well. Term sheets can be done over email or in kind of one-page documents, but it is often better to get lawyers to put them together, because we can at least write things in there that are consistent with what we're going to put in the real documents later on. But yes, at that point you come to the lawyers. The lawyers will then prepare the shareholders agreement, the constitution, if it doesn't already exist, and the subscription agreement. And these are the documents which actually formalize what the term sheet says. So the subscription agreement is the kind of investment doc. The subscription agreement says, I, the investor, promise to give you this much money to this bank account on this day in exchange for this many shares. And you promise me that, when you gave me your presentation, everything you said was true. You're not lying or hiding things, and I'm investing on that basis. And those are called warranties. So the subscription agreement is the investment document. It's pretty straightforward. It's just an amount of money in exchange for an amount of shares and some promises about the company. And then we have the shareholders agreement. So the shareholders agreement is the kind of ongoing document that says, once you have become an investor, now you are a shareholder, you own a percentage of the company. What rights do you have? What rights don't you have? You only own a minority, so what can and can't you do? And it might say, for as long as the investor holds more than 5% of the shares, they have a board seat and they can be involved in decisions. Or it might say the investor has no board seat, but the company may not raise further investment without first offering it to the investor, or the company can't change direction without the investor's approval, or the company can't pay the founders more than X dollars without the approval of the investors, so on and so forth. So a lot of that information is in the shareholders agreement, which is kind of your ongoing document. And the constitution is these days a fairly standard document that just explains how often shareholders need to meet, how often directors need to meet, and when they meet, how those meetings should be run and how decisions must be made in practice. So these are often fairly straightforward documents, but the shareholders agreement really sets out all of those details around control, and the subscription agreement sets out the terms around investment. Now, depending on where you're at, we discussed earlier, your structure might be in the process of being finalized. There's all these other documents you might need to set up. So there can, at the same time that you sign the subscription and shareholders agreement, be other little side documents that need to be signed, IP assignment agreements. If you haven't got proper employment agreements in place, maybe you're doing them, or maybe the investors have asked you to update your employment contracts. So there can be other things that need to be done around the time the money comes in, but it's really these kind of core documents, if that makes sense. That's the kind of key legal documents. Now, I've mentioned these in passing, but what are the terms that investors are asking for? A question we often get is, okay, I'm going to bring on these investors. I'm happy to take their money, but what rights do I actually need to give them? The answer to that question totally depends on the relationship between you and the investors, what kind of investors they are, and to some extent, how much control that you as a business or founders want to give up. But these are the common things that you see founders give up to investors. They give them a seat on the board, as I mentioned. They introduce what's called founder vesting. So, for example, an investor may put in the $200,000, but say, I'm putting in this $200,000 on the basis that I'm only getting 10% of the company. But if one of these two founders leaves tomorrow, I don't want them to retain more equity than me when they're not even involved in the business. So it might say the founders have to stay with the business for a certain amount of time, otherwise they'll lose their equity. So that's what founder vesting is. There might be restraints. I'm putting in this $200,000, but you, the founders, promise you won't take my money, do a bunch of research, shut down the business, and start another business I'm not involved in. You'll be restrained from starting competitive businesses for some period of time after this business. They might want information access. I want quarterly updates, access to your financials. They might want warranties, promises about the state of the company, that the founders aren't, former criminals or anything like that. And these last two, liquidity preference and anti-dilution, I discussed these concepts already, but these are these kind of special class rights that sometimes you'll give investors, which are, on paper it says they may own 10%, but that 10% might have elevated status. One of these is a liquidity preference that you often see, which again is the scenario I described already. Yes, the investor only owns 10%, but if the company sells for a very low value, rather than them getting 10% of that low value on liquidation, they get back their investment rather than the 10%. So they get back the 200K in my example. So you often see that as a protection for investors. They're going to get the returns if the company does well, but if the company does badly, at least they get their money back rather than getting 10% of not much. So that's a term investors will often ask for. And then anti-dilution is protections. Again, if the company raises investment saying it's worth 2 million, 6 months later, it raises investment again, saying it's only worth 1 million. Obviously, the original investors are a bit annoyed, so there's often some clauses in there that allow them to top up a little bit if that scenario emerges. So these are common concepts you see. They live often in the shareholders agreement or the subscription agreement, and are things that the investor might get on top in an equity round of their straight equity percentage. Sorry, 1 second. Just got to reshare. Hopefully everyone can see my slides again. And just wanted to answer a couple of the questions. So what do you do if one shareholder from the 15 won't sign a shareholder agreement? I guess the way that the shareholders agreement works is it's signed at the moment of investment. So they, in a sense, can't become a shareholder unless they sign the shareholders agreement. That's how it typically works. If you're in a situation where you didn't do a shareholders agreement and you want to add one in later, you're in a bit of a pickle if the person is holding out, and they in fact do have some leverage. And that's why it's really important to get legal advice and do the shareholders agreement at the beginning. But yes, typically, if someone signs a term sheet but won't sign the shareholders agreement, they just can't invest. The investment won't be finalized. The money only typically comes in and the shares are only issued after the shareholders agreement signed. So it's the chicken and the egg, if you will. Mel's asked, some investors have mentioned an investment memorandum. Is this the same as a term sheet? No, it's a little different. The IM is more synonymous with like a pitch deck. So a pitch deck is not really a legal document. It's like a document people will be familiar with that sets out your business, your plan, your strategy. An IM is like a long form version of your pitch deck. Sometimes it's many more pages. It has a lot more text and writing, and explains your full business plan. It may have a slide at the end that describes the term sheet, but it's typically a kind of a sum up of the investment. These days, unless you're working with large private equity funds, if people are asking for investment memorandum, they're probably just asking for a pitch deck. But if they want to see something more detailed, they might be asking for a detailed pitch deck. For larger companies, investment memorandums are more common because a simple pitch deck is not enough information to make a decision to invest in a company. So yeah, that's what the IMs are. God has asked, what's the approximate cost for an equity raise by you? It kind of depends on how much of these other documents you'll need and how complex the process is. It's one of the more difficult things for us to price. We really like to give upfront fixed fee pricing, but we do struggle to give confirmed prices for equity raises. But to give you a sense, I think we charge between 1,500 to 2,000 for a shareholders agreement, and I think we charge around 1,000 for the subscription agreement. Constitutions, often you'll just have a template one that's good enough, so we may not need to touch those. Term sheets can be 500 to 700. So, if you add all that up, you're looking at 3.5K, and then to add some buffer in, I'd say 3.5 to 5,000 for at least a seed stage round. Can get more complicated if there's more investors, more things to do, but with Sprintlaw, yeah, 3.5 to 5K roughly, I would say, for a simple one of these rounds. Someone's asked, what are the ways to do evaluation at a seed stage in the absence of an actual valuation? How can I offer a percentage to the investors? So yeah, that's a good question. I when I discussed earlier the term sheet example, or the kind of invest receive Y, I talked about 200K is 10%, implying a valuation of 2 million. Well, the question is, how do you actually set those numbers? And again, not really a question for a lawyer. It is a business question, I suppose, something that some valuers and accountants do, or venture capital firms will do of your business. But in my experience, valuations for companies are often not based on all that much. It's difficult to do forecasts and models for early stage businesses. The best you can say is, if your business is a software business with a huge market, it might be worth a lot. And if your business is a service business with a very small market and it can't grow very, very, very well, it might not be worth that much. But what a lot and that much and not that much mean is very subjective. And what you typically see happen with these valuations is it's a bit of supply and demand. If the company is really popular, it's got a great pitch and a lot of interest, the founders can command a much higher valuation. If they're struggling to raise investment, they might end up commanding a lower valuation. But the early stage valuations are not that scientific. They are often just based on the negotiation process and what if you go to a venture firm, the venture firm says. So for all of Sprintlaw's rounds, pretty much we have set the valuation. We've spoken to venture firms and gotten a sense of how they might value our business, but we've eventually had substantial interest, and we've just set a valuation not based on an independent valuer's valuation. We've just said, we, the founders, are willing to give up this much of the organization. We think this implies this valuation, so this is kind of what we're offering. And we had enough interest for people to accept the valuation. And ultimately, they're going, well, I think the company will be worth a lot more one day, and I'm willing to take the risk to invest. So people can get very caught up in valuations. And again, I'm not really speaking as a lawyer here, more as an entrepreneur in terms of my experience. But I would say a lot of the time the valuation is just kind of set that way. And even these days online, you can see some benchmarking. I think Cake Equity has some great resources on their website where they have listed the common valuations you see for seed stage companies versus post-revenue companies, et cetera, et cetera. So you can check that out and use that as a guide for how you might value your business. But ultimately, I would just speak to a lot of people, look at other businesses that have raised before, and try and come up with a valuation rather than doing anything too scientific. Okay, we might just move now on to safes and convertible notes. I'm conscious of time. I will go a little bit over past the hour, but those that need to drop off at the hour mark, we can circulate a recording if you want to catch up on a few slides. But let's talk now about the safes and convertible notes. So I mentioned earlier, the safes and convertible notes are kind of like the pre-sale tickets to the equity show. What you're getting as an investor on a safe and convertible note is a discount on the price per share paid by investors coming in at the future round. So let's just dive into that a little deeper. So in the scenario of the 200,000 investment in the $2 million company, in the straight equity round, the investor's getting 10%ish of the company. If it was done as a safe note or a convertible note, instead the company might say, hey, look, I would like you to put 200,000 into the business. And in exchange for that 200,000, I will give you a 10% discount on the price per share paid by investors at my next funding round. So at my next funding round, I then decide to find some other investors. I do an equity round. I let them invest at a $3 million valuation because my company's now a bit bigger. It's gone up. I've used my safe money or convertible money to do some stuff. My safe investors will now get a discount on the price per share. So instead of, let's say they put in 200K, instead of getting 200K over 3 million, they're going to get 200K over 3 million with a 10% discount. So they'll get 200,000 over 2.7 million, if that makes sense. So they get a little more equity than they would if they just invested later on. So they get a better deal than other investors coming in at the 3 million valuation because they got a discount. But for the company, they didn't have to raise at the 2 million valuation. They were able to wait it out, grow a little bit bigger, and command a higher valuation. So the investor does get a return because they're getting that discount, and the company is also not forced to lock in a valuation for their business right now while they're so kind of small. So you can see why the safe notes or convertible notes can be attractive to companies to do the discount thing. And it kind of also touches on the question I was just answering in terms of valuation setting. It can be very difficult to set a valuation for an early stage company. And so you defer the question of the valuation until a future time if you use these safes and convertible notes. Plus, these documents are much simpler. I spent a bunch of time going through the shareholders agreement, subscription agreement, constitution, term sheet, all the stuff you need for an equity raise. The safe notes or convertible notes are really short documents, 5 to 10 pages. The investors at the time they invest, they don't have any control rights. They're not even necessarily joining your shareholders agreement. They'll do all that later when you do the proper equity round. For now, they're just giving you money for the discount. And so again, for founders that need to close rounds quicker and don't have the time or funding really to do the proper equity round, these can be a great bridging instrument. And again, to use the example of Sprintlaw, we've done multiple safe note rounds. Our first round was a safe note, and then we later on did an equity round, and then we did another safe note and another equity round. And I certainly would say in the last 5 years, we've seen these safes and convertible notes become, I'd say for startups, probably the dominant form of initial fundraising. It used to be equity rounds, but these have become very popular for startup companies because they're so simple. So there are a few other terms in these documents. You have valuation caps. So what they are, if I can run through my scenario again, okay, we've got a $200,000 investment with a 10% discount. The question for an investor is, okay, well, I'm happy to get a discount, but what happens if your company blows up? It explodes in popularity, I mean, not actually fails, but it becomes really, really popular. It does exceedingly well, and your company's suddenly worth $50 million. And I invested before that. I enabled that, and you're only going to give me a 10% discount on $50 million. That doesn't seem fair. It's a fair enough point for an investor to make. So this concept of valuation cap is sometimes introduced into safes and convertible notes, which says, okay, I'll give you the 10% discount, but if we do exceptionally well, I'll cap it. I'll cap it at, let's say, 5 million. So you get a 10% discount on our next round, but if we end up being worth more than 5 million at our next round, instead, I'll just convert you as if it's 5 million. And so you don't need to worry about the fact that we're worth 50. The worst case scenario will convert you at a 5 million. But if it's anything less than 5 million, you get a 10% discount. So it's an investor protection, and you can kind of see the benefit there for investors. They're not getting the equity now, so they just want some guarantees that later on that they're not going to get kind of screwed over because the company was worth so much that their discount becomes meaningless. The other terms that you see in safe notes are a maturity date. What happens if you never raise that round that you're promising? Am I ever going to get my equity? So sometimes there'll be a hard stop. If in 2 years nothing happens, we'll give you a backup amount of equity. The challenge with that, of course, is you've now got to work out what the backup equity is. Then you've got to think about the valuation. And now, you're almost in the land of doing an equity raise right now. So maturity dates aren't that common, but some investors do want them. You've got interest that doesn't exist in safe notes, but convertible notes often have interest on them as well, and that's the main difference between the two. So it will say, if you don't do anything by this date, you've got to repay us instead of giving us equity. And also, we invest 200,000, but for every month that you wait to do this future event that will trigger us into equity, we want our 200,000 to be earning interest, so that when the time comes, not only do we get a 10% discount, our 200,000 is worth 220,000 because it's been, X amount of time. So you sometimes see those in these documents. And finally, we've got the conversion trigger, which is just a definition of
what is actually going to trigger this investment? Is it just a tiny little raise, or is it a proper $2 million funding round that turns these safes into equity? Yeah, that's the kind of safes and convertible. Conscious that we've hit the hour. As I say, I am going to keep going for those who are interested for another 5 to 10 minutes. Yeah, if you want to drop off as well, totally understand. There's only a couple more slides to get through. So we've talked a lot about the legal documents and so on that's required for equity investments. We've talked about the equity rounds as well as the convertible rounds. One thing to keep in mind is if you are raising funds in Australia, it is almost as simple as getting the document signed and the money coming in, but there is a piece of law called the Corporations Act that says, if you want to raise funds without issuing a full disclosure document, prospectus sort of thing, which public companies have to do. Whenever a public company raises money, it's got to issue a really long, what's called prospectus, which describes the business, highlights all the risks, and makes it easier for individuals to understand the risks of investment. For startup companies, we often don't want to do that. Pretty much always we don't want to do that because it's a lot of effort. And the Corporation Act said, fine, for small companies, will allow you to just raise without issuing disclosure documents, but only if you fall under one of these conditions. And the conditions, there's quite a few of them. I've got the most common 3 here. One is that the people investing are what's called sophisticated investors. So they have high net worth or high income. And so investing in a risky company like a startup is not going to sort of bring them to financial ruin. So if all your investors are sophisticated investors, they can invest. If you've got people that are just friends and family, but they're not meeting the test of sophisticated investors, there's actually a definition in the Corporations Act of friends and family. And if they meet that definition, they're allowed to invest as well. And finally, there's this 2012 rule, which is a bit broader and says if you raise from less than 20 people and raise less than 2 million in any 12-month period, that's also fine. It's considered a small scale raise and you don't need to do all this compliance requirements. So it's important just to make sure that the funding that you do ticks these boxes. You can't go posting on Instagram saying, hey, we're raising funds for our company and kind of offer it to the public in general. That would be breaching these corporations laws. It has to be private offers and the investors have to meet these tests. The one exception is the equity crowdfunding. If you do that through a registered platform, it does allow you to do a little more of that marketing style investment. But for the most cases, it's just important to remember that this is kind of regulated, and you just want to make sure that you're not breaching these laws when you raise. And then just finally on the other funding types, again, no time to go into them in detail, but if you get money from grants, there's often agreements you will agree to. We touched on loans, but to finalize a debt investment, there's a single document called a loan agreement. Sometimes there's security that you will put up, business assets and so on for the loan, but it's fairly straightforward. It's just here's the money and here's the interest rate and here's the repayments. If you raise on crowdfunding, always check the platform terms to make sure that you're following the guidelines and the rewards that you offer. And if you do the equity crowdfunding, the documentation's a little different. And again, best to speak to the platforms to get more information on that. But typically, when you do an equity raise on an equity crowdfunding platform, you actually don't have a shareholders agreement. You have a very sophisticated constitution, just because it's simpler to get signatures from a ton. It's very difficult to get a ton of signatures from people on a shareholders agreement. So we often just build it into a single, more sophisticated constitution. So that's the main difference in documentation with the equity crowdfunding. That's all the slides I had. We got a bunch of questions, which I'm going to attempt to quickly answer for those that want to stick around. So I'll just pull those up. But for those that want to drop off, thanks so much for joining. And we do also have, as I mentioned, the kind of free consult available for people that want to ask some questions. So let me just go through some of the remaining questions we have here. Kyle's asked, is there a limit on the amount you can raise? Are there conditions from ASIC? I think I kind of answered that one just now. There's no limits if they're sophisticated investors or friends and family, but if you're relying on this exception, there's this 2 million 12-month rule. Otherwise, you can raise very large private funding rounds from venture capital funds, and there's no There is a limit of the number of shareholders you can have while you're private. In Australia, it's 50, but not on the funds. Maria's asked if we already have a shareholders agreement before investors are in place, are we making a new one when they're on board or updating the previous one? Great question. Typically, you will be adjusting it in some way. Whether it makes sense to do an entirely new one or update will just depend on the situation. It is actually in your interest to have one in place and get it updated before investors are coming in, because if you wait for the investors to come in, the investors will have a lot more of a say in terms of what the shareholders agreement says. Whereas if you start with one, it's kind of your opening negotiating position. You can say, and we have this shareholders agreement here, and it says what you'll get. And if the investors want to ask for stuff, you can show that you're going to have to update this document, and it's a bit of effort. So I think it's a good idea to have one in place, but whether you keep it or adjust it just depends on the vibe. But yeah, it'll be better if you just have to tweak it and not do a whole new one, unless the shareholders agreement is a very poor quality shareholders agreement that really should be rewritten, which we do also see quite often. Someone's asked, what about giving money to your own company? Can you do that, or does it have tax implications? You can put money in your own company. You can do it as an equity investment, as a loan. It can have tax implications. So yeah, you want to get advice on that. And there's multiple different ways to put the money in. It is common though for founders to either loan money to their company or buy equity in the company, particularly if one founder is stumping up more cash than the other. That might be reflected in an investment amount. Yeah, if that's something you want to do, I just ask your accountant about how you should put it in, but it's quite common to see that happening. I think, okay, Mel's asked, do you know of any social enterprises that raised by equity crowdfunding? That's an interesting question. I don't off the top of my head, but if you go to Birchel's website, I think they got a list of all their raises. I wouldn't be surprised if there has been one. There's no reason why there couldn't be, and I think it'd be a great way to raise for a social enterprise. How do you record funds collected via straight equity? Amas asked, do you recommend to record as a loan to the holding company and pay back, or record as a share value under equity? Well, if someone invests via straight equity, they're a shareholder. So it's recorded. I'm not sure exactly how the accounting works, but I believe it's recorded as equity, not a loan on the books. Safe notes and convertible notes are recorded as a loan on the balance sheet, I believe. But the equity, yeah, is equity. I mean, the people are owners in the business, so there's no obligation to pay back the amount that's invested. That's the point of the equity. Whereas with a loan, you have to pay it back. With an equity, there's not like a time period that you pay it back in. People are joining you for the journey, and will hopefully receive either dividends or funds on exit of the business. James has asked, a lot of people hesitate to put the trust in because they don't want the complexity of trustee company, but with a good trustee, is it worth putting in a trust with individual trustees, then insert the corporate trustee with minimal tax issues? Again, yeah, that's probably a tax question to ask your accountant. I would say I haven't seen that done that often. My understanding is that it's more effective to have the corporate trustee from day one, and there can in fact be issues if you try and swap from an individual to a company later. But yeah, definitely a more of a tax question that I'm not an expert in. And I think I've answered a lot of the other questions. Maria asked a good question earlier. What's the best time cost, paper efficient procedure to set up a company? Set up a company with one director, make a shareholders agreement, invite investors to set up structure, or set up a company with one director, make two shareholder agreement from the beginning, and other founders. It kind of depends on how many founders you have, when the investors come in, and so on. But I would say it's if you know who your co-founders are and directors are from day one, I would set up your company with the shareholder split in place on day one. So to give the example of Sprintlaw, on day one, we were founded with 2 directors and 50-50 shareholding is how we did it. Then we invited investors to the already set up structure. And I think that was good too, because again, we have, like I said, with the shareholders agreement before, we have, and we had a shareholders agreement as well. We had infrastructure in place, and it was a stronger negotiating position to say, we're already a company. This is the share structure. Here's our shareholders agreement. Do you want to join? If you want us to change stuff, there better be a good reason. So I think it's good to kind of start that way, have everything in place, and then approach investors. The more you get investors involved in the structuring of your business, the more say they get, and you may want them to have a say, but you at least want some control over what say they get. Because again, typically as founders, you want to make sure that you don't lose control of your company. A couple of new questions at the end. Someone's asked, can you help me on legal setup, access to investors? We do have plans in the next couple of months with the platform to introduce a kind of funding hub thing where our companies, our clients will be able to at least submit their deck to a pool of investors that we've worked with before, funds and so on. So that may be coming. For now, I wouldn't say it's a part of our service, but if there are funds that people want introductions to, do reach out to our team. And if we know someone there, we'd be happy to facilitate an introduction. Do you have examples of business models where staff are owners? Yeah, so I think we have another session coming on employee share option plans. But if you just have a bit of a read about ESOPs or EMIs, in employee share option plans, that's the common way where staff own a percentage of the business. They're not shareholders or investors in the same way as the actual owners. But there's a way that a lot of startups use to give a little bit of ownership to their team through these ESOPs. Again, Cake Equity, I think, are the probably the most well-known brand in helping facilitate that in Australia. So if you just check out their website, they got tons of resources explaining how you can get staff involved in the ownership model. Yeah, that's kind of how that works. And then maybe I'll just I'll see if I can do a couple more, and then yeah, I might let people go unless people are super interested in hearing all these specific answers. Mel, that's Cake Equity, yeah. So like kind of birthday cake. Yeah, if you Google them, you should find them. So Catherine's asked, I would like to understand whether we can have time invested paid back by a founder's loan. Yes, you do see that. I would say it's not super common for founders. Founders often just tie up all of their time into I guess their equity stake, and they're kind of all in on the business, hoping that if the business equity is worth a lot, either through dividends or a sale, that will be their return on investment. But you do sometimes see with business partners a record of time spent at some hourly rate that goes on the books as a loan and gets paid back by the business in future. So again, probably something to discuss with your accountant. And Joel's asked, for raises after the first seed raise, where disclosures offers for available shares need to be offered to current shareholders before making it available to new investors, do these obligations still apply if raising with safe notes, or do you only have to disclose the raise to existing shareholders when it becomes an actual equity raise? That's actually a really good question. So it depends on how well your shareholders agreement's written. But the short answer is you can't really do a subsequent safe raise without first offering it to your existing investors. Even if the shareholders agreement is silent on it, which it sometimes is, it doesn't explain, it'll often say, as you kind of alluded to, before more shares are issued, they must be offered to existing shareholders. That's often what the shareholders agreement says. If you're going to do a safe raise where you're not actually giving out equity yet, you could sign the document without breaching the shareholders agreement. But when the safe comes to convert, you might not be able to give the safe holder what you promised if you haven't got approval from your existing investors, because you'd be there for kind of issuing shares. So we recommend for nearly all scenarios, if you're doing a safe raise when you have existing shareholders, offer it to them first and get a waiver. If they don't want to move ahead with it, then you can go out to others, rather than kind of doing it in the background. And we've seen some issues emerge where companies kind of went rogue, downloaded an online safe note template, and then ended up in very complicated situations. So it's a good question. And yes, that's kind of how I'd recommend handling that specific scenario. Maybe this will be the last one I do. Can the business get a safe note signed without all the shareholders signing? Yes, they can. The safe note is signed between the company and the investor. But as I said in the previous answer, you would need to at least get approval from existing shareholders to go out and sign safe notes in general, either by a waiver or some other format. but the actual signing doesn't need all the signatures. It's just between the company. I think I answered the other two questions a little earlier. So glad to have got through everything. Thanks everyone so much for attending. Bunch of great questions. If anyone has feedback on how we could do these better, or the information that we shared, would love to hear it. Just reach out to our team, and of course, please do feel free to sign up to our Sprintlaw membership, and take advantage of that free consult. We'd love to work with all of you. Thanks so much, everyone, and we'll see you soon.